welcome to the deep dive. When the headlines scream about the AI revolution, most people are focused on, the amazing chatbots, the smarter algorithms, all the dazzling applications.
Right.
But if you peer past the software and the model performance metrics, you realize pretty quickly this isn't just a software movement.
No, not at all.
It is, first and foremost, a massive, costly, and incredibly high-stakes real estate and financing rush.
Exactly. We are talking about trillions of dollars being leveraged right now.
Trillion?
Not just to buy chips, but to pour concrete and build these gigantic data centers. Our mission today is to give you a shortcut to being informed about the money behind this boom.
Okay.
We're going underneath the hood to analyze what financial analysts are already calling AI debt, the massive capital commitments big tech is making. And we're going to center our entire deep dive around one defining relationship.
The Oracle OpenAI alliance.
That's the one, because that is the benchmark for aggressive scale right now.
And when you look at the scale, it is instantly, it's mind-boggling. This is not incremental spending.
Not even close.
So far in 2025 alone, the issuance of debt specifically for AI infrastructure has already soared past $100 billion.
And just for context, that figure has nearly tripled the annual average over the past decade.
Tripled.
And astonishingly, that $100 billion is considered just the appetizer. When you look at the long-range projections, the numbers become, they become colossal.
So how colossal are we talking?
McKinsey projects that by 2030, the global capital expenditures needed just for AI data centers, so this is separate from traditional IT workloads,
Right.
will require an estimated $5.2 trillion in investment.
$5.2 trillion. That's a figure so massive it barely registers. It means the need for compute capacity is essentially unquenchable right now.
And the race to fund it is completely redefining what we consider normal corporate risk and leverage. It is the ultimate land grab, financed by debt.
Okay, so let's unpack this with the biggest, most aggressive example we have, the Oracle OpenAI deal.
Yeah, this partnership is the defining case study.
It really shows how big tech is deploying capital to secure future AI revenue.
The specifics are truly staggering. In September 2025, Oracle and OpenAI announced this landmark cloud computing contract,
The big one?
valued at $300 billion over 5 years.
Wow.
This deal is scheduled to start hitting high revenue volume in 2027, and it's designed to supply OpenAI with roughly 4.5 gigawatts of compute capacity per year.
That's a massive amount of power. To help you visualize that, 4.5 gigawatts is enough continuous electrical supply to power nearly 4 million average U.S. homes.
All of it dedicated just to running AI models.
Incredible.
And this isn't just some regular customer contract. It's directly tied to a monumental infrastructure plan they've dubbed the Stargate project.
Stargate.
Yeah, Stargate is this massive, multi-year, multi-partner initiative. It involves OpenAI, SoftBank, Oracle, and it's reportedly backed by the U.S. government.
And the goal?
The goal is to build up to 30 gigawatts of AI computing capacity across the country.
30 gigawatts. And the total investments to realize Stargate across all its partners could potentially reach $1 trillion.
$1 trillion.
That sounds less like a business plan and more like a national utility build-out.
It absolutely does. And to realize just the first phase of that OpenAI contract, Oracle has had to shift into, capital overdrive.
Okay.
We saw their capital expenditures, their CapEx, in Q2 of 2026 hit an unprecedented $12 billion in a single quarter.
Wait a minute. $12 billion of spending in 3 months. What did that do to their financials?
It led to their free cash flow turning negative by $10 billion for that quarter.
Negative $10 billion.
Yeah. Now, for anyone who's not a finance expert, that negative $10 billion is an enormous alarm bell. It's essentially telling the street that for every dollar they earned, they had to spend significantly more just to build the foundation for future revenue.
So it's a complete reversal of their traditional, highly profitable software business.
A complete reversal.
They are paying today for revenue they might see in 2027. So they're effectively borrowing money to buy future customers.
Precisely. And their management guided the market for a staggering $50 billion in CapEx for the full fiscal year.
$50 billion.
And we have sources that estimate roughly $40 billion of that is just dedicated to acquiring about 400,000 of the newest NVIDIA GB200 GPUs.
So they're just filling these new facilities. This isn't incremental growth. It's a massive, immediate infrastructure shift built entirely on leverage.
And you can see the shift physically, too. The scale of the data center construction is enormous.
Like the one in
The
Texas.
core U.S. Stargate site in Abilene, Texas, yeah. It's expanding to 8 buildings designed to pull 900 megawatts of power. They're positioning it as the world's largest AI supercluster.
And the financing to support this has to be just as massive.
It's Herculean. We saw a new data center campus in New Mexico that required over 20 banks to arrange an $18 billion project loan. And right now, we know negotiations are actively underway for another $38 billion loan for more U.S. site development. The traditional debt markets are backing this, but the sheer size of these loans is just unprecedented.
That brings us to the core issue, this financial tightrope that Oracle is walking. Given that scale of spending, how does that balance sheet compare to the rest of big tech?
This is where it gets really interesting and, frankly, a bit frightening.
Okay.
When analysts model this leverage gap, they calculate Oracle's current debt-to-equity ratio at a whopping 500%.
500%. So that means for every dollar of shareholder equity they have $5 of debt.
Correct. Now, compare that 500% to its big tech peers, Microsoft, Meta, Amazon, Google. Their ratios are typically between a highly conservative 7% and 23%.
So Oracle is in a different universe.
A completely different universe.
I mean, for comparison, if I bought a house with a 500% debt-to-equity ratio, I'd be sleeping in a tent and facing bankruptcy. How is Oracle even selling this to investors?
Well, their absolute debt is high. You're right. It's roughly $100 billion.
Which is more than Microsoft's rate.
It actually exceeds Microsoft's $80 billion in debt. But the comparison is misleading.
How so?
Because Microsoft has 17 times the equity cushion to absorb that debt. That 500% figure for Oracle represents an extremely concentrated risk profile.
But wait a minute, Oracle still maintains an investment-grade credit rating.
It does.
So the rating agencies like Moody's or S&P, they view its bonds as generally safe. Doesn't that prove the market is overreacting?
That's the classic friction point in finance, and in this case, the market is sounding the alarm louder than the agencies.
So while the official rating is investment grade,
Oracle's bonds are trading like junk. We track this using credit default swap spreads, basically the cost to insure against a default. Oracle CDS spreads hit 1.26%, the highest on record.
so the market is skeptical.
The skepticism is palpable. Investors believe the probability of default is higher than the ratings officially imply.
This friction actually highlights a really important concept in fixed income investing, something bond traders call the bums problem.
It's a fantastic piece of jargon.
Let's dive into what that means.
So, the bums problem describes a specific flaw in how traditional investment-grade bond benchmarks work. Imagine you're managing a passive fund that has to track a specific corporate bond index.
Okay.
That index is weighted by the amount of debt outstanding.
So if a risky company just issues a massive number of new bonds, say 100 billion overnight, suddenly it dominates your index.
Exactly. A company's weight in the benchmark goes up as it issues more debt, regardless of whether that company is actually getting safer or riskier.
So if Oracle issues 100 billion in investment-grade debt, it just takes up a much larger space in the index.
And it forces passive funds, the index huggers, to buy it, even if they think it's highly risky. The index has to allocate more money to the biggest bums, the biggest issuers.
That's a major structural distortion. So how do active managers respond to this? They can't just ignore the risk.
They cannot. They respond strategically. They might selectively add positions based on strict valuation, or, and this is crucial, they might just participate in new issues only to sell them on the break. Meaning they buy the bonds at issuance and then quickly exit for a near-term profit. They get out before the long-term risk profile matures. They're using those passive funds as their exit liquidity.
So we have Oracle loading this massive debt, 100 billion, directly onto its corporate books. But we know the other hyperscalers have found creative ways to mitigate this, right?
They have. They've pioneered risk mitigation strategies. Microsoft and Meta, for example, they frequently use what are called special purpose vehicles, or SPVs.
And these are designed to keep the debt off the main corporate balance sheets.
Precisely. The SPV issues the debt, builds the data center, and then the hyperscaler just contracts with the SPV to rent capacity. So if the project fails, the debt defaults. But it doesn't directly harm Microsoft's or Meta's core credit rating.
Right, like that Microsoft and BlackRock partnership to acquire Aligned data centers.
A perfect example. Oracle, by contrast, is loading so much of this risk and exposure directly onto its main balance sheet, and that magnifies the perceived risk.
And we saw a very recent stress test of this market fragility.
The Blue Owl withdrawal.
That rattled a lot of people.
The event was a huge catalyst. It signaled a real shift in market psychology. Blue Owl Capital, a major private debt firm, reportedly walked away from backing a $10 billion data center project.
A project that was meant for OpenAI, the biggest name in AI. Why did they walk away?
Their reason, which immediately rattled the debt market, was that the firm believed the AI infrastructure boom it looked like a leverage-heavy expansion with insufficient immediate cash flow to guarantee repayment.
So that rejection from a private debt giant.
It shifts the market psychology from complacency, this idea that big tech is too big to fail, to reflexive risk reduction.
So on one side, you have this massive debt-fueled build-out, but on the other, we run into this core conflict. The cost of compute is collapsing faster than these data centers can be built and paid for.
This is the technology efficiency paradox, and it's what keeps CFOs up at night. The major model builders, like OpenAI, they're not profitable.
They're running massive losses.
OpenAI reportedly lost about $5 billion in 2024 alone. And they have no immediate proven way to generate enough revenue to cover the current staggering cost of compute.
And the reason their costs are dropping so fast isn't because NVIDIA is slashing chip prices.
No, not at all.
It's all because of architectural breakthroughs, and this is where the tech innovation directly clashes with the financial model.
It's purely internal optimization. Research shows that achieving equivalent AI performance became an astounding 280 times cheaper between November 2022 and October 2024.
Just think about that for a second. 280 times cheaper in 2 years.
Yeah.
It's like buying a brand new top-of-the-line supercomputer today, knowing that in 24 months, a cheap laptop will run the exact same tasks 280 times faster. How does any CFO budget for that?
They can't. If you look at API pricing, which is a good proxy, the cost for GPT-4 output tokens dropped from $60 to $10 per million in just 16 months.
An 83% price reduction.
And like you said, that isn't because the chips got cheaper. It's because the models got smarter about using the hardware they already have.
Right, these new architectural techniques.
Precisely. Things like mixture of experts or MOE, where only relevant parts of a massive model are activated. That massively cuts usage costs. Then there's quantization, which cuts memory requirements in half.
And distillation.
And distillation, yeah, training smaller, more efficient models to mimic the big ones. This constant, rapid efficiency gain, it just undercuts the economics of the multi-billion-dollar infrastructure built for last year's models.
Which brings us directly back to counterparty risk. Oracle is making this colossal 5-year, $300 billion bet on OpenAI.
A single, highly unprofitable customer facing enormous technical efficiency headwinds.
Barclays analysts have been pretty clear about this exposure.
They've projected that OpenAI could represent up to a third of Oracle's total revenue by 2028.
A third.
That level of dependence just layers counterparty risk right on top of the financial leverage risk. It emphasizes the gold rush analogy perfectly. The shovel sellers like NVIDIA and the jewelry makers, Meta, Microsoft, using AI internally financing with SPVs.
They're arguably safer.
Much safer than the gold diggers, the model builders, and the new cloud providers.
That seems like a very difficult pitch to investors. Now, to be fair, Oracle has mounted a defense. What are their main counterarguments?
Their first defense point is volume and demand. They cite their massive backlog, their remaining performance obligations, or RPO.
Yeah, and that stands out.
It's currently at $523.3 billion,
Right.
an increase of 433% year over year. They say they'll see much faster revenue conversion from this.
So they're saying, look at the demand, not the debt.
Exactly. And they also highlight their flexibility in financing. They can use customer-bought chips where the customer buys the hardware.
Okay, so Oracle just provides the cooling and the racks.
Right, or they use vendor-rented capacity. Both of those strategies significantly reduce Oracle's need for upfront CapEx and borrowing.
And what about the risk of a single customer, like OpenAI, defaulting, or just becoming so efficient they don't need the capacity?
They stress the fungibility of the data centers. Oracle's management says their facilities are so flexibly designed they can transfer capacity from one customer to another in a matter of hours, not weeks.
So they argue the capacity itself is the asset and the customer is interchangeable.
That's the argument.
So the tension is clear. Before we wrap up, we should touch on the broader implications of these massive partnerships.
A major one is regulatory scrutiny. When you have this much capital concentration, the regulators pay attention. The FTC has raised concerns about high switching costs, creating lock-in for startups like OpenAI.
And the Europeans are signaling strong oversight as well.
Absolutely. The EU AI Act carries substantial penalties. Fines can reach 3% of worldwide annual turnover. For a company like Microsoft, that could easily exceed $6 billion. The pressure is mounting.
Now, it is easy to view Oracle's investment just through the lens of data centers and chips, but Larry Ellison is explicitly tying this back to Oracle's core software strength.
That's the real strategic genius here. Oracle isn't just building a commodity cloud. They're positioning this infrastructure to enable AI models to do complex multi-step reasoning on private enterprise data.
Through their own database and AI platform.
Exactly. They want to be the secure environment where private company data meets large language models.
And this strategy, this integration, it's already having a halo effect on their legacy businesses.
It is providing a significant boost. Fusion ERP was up 17%, their industry cloud apps up 21%. A great real-world example is Tim Brazil. They built AI agents on OCI, the Oracle Cloud, and achieved 18% faster issue resolution.
30% faster service times.
They're proving the immediate business value of having this infrastructure.
What a dramatic narrative. We have big tech committing trillions in debt and CapEx for AI dominance, yet the efficiency of the technology itself is constantly threatening to make that very infrastructure obsolete. The central question for you is who is truly positioned to win in this high-speed, high-leverage arms race?
This whole AI debt story, it isn't just about corporate finance. It defines the core strategic challenge of the decade. Can the revenue and profitability materialize quickly enough to pay for this gargantuan $5 trillion build-out before architectural efficiency makes it economically unviable?
It's a high-stakes moment.
It really is. We're in a moment where execution timelines and the speed of tech innovation are wrestling for control of the balance sheet.
And this is the provocative thought we'll leave you with. For truly ambitious technological visions, whether it was the early internet or generative AI today, the market might actually have to remain irrational long enough, backing the unproven with massive capital and risk, simply to buy the time necessary for the technology to mature and for the business model to become a reality.
If the market keeps the faith, the vision eventually becomes the reality.
Until next time, keep digging.